Well, it's good to see you, man. I figure if you don't mind, maybe we kick things off, give us a little bit of background, talk about what you guys are up to. I know there's a lot of exciting stuff that we've all had conversations about, but tell us a little bit of your background, introduce yourself to everybody. That'd be great.
Great. My name is Don Musso. I started FinPro way back in 1987 as a consulting and investment banking firm focused on financial institutions. So, been 37 fun-filled years. It's the longest I've ever held a real job or a continuous job anyway. I remember when I started the company, I told my wife I was just going to do it while I was looking for a real job. And every now and then she'll come to me and say, "Well, are you ever going to find that real job?" So um, we've got FinPro's got about 400 community bank clients across the country. We do a lot of strategic planning, a lot of asset liability analytics. We do a lot of regulatory consulting. We do a lot of de novo work. Pretty much if it can benefit a community bank, we're probably involved in it in some way, shape, or form. And most recently, we've been very active in working on bank liquidity that came out of the failures of Silicon Valley and the like a year or so ago. And we're also working on a solution to community bank uninsured deposits. So it's been a fun-filled 2024 so far.
That's great. Interesting time.
Yeah, that's really what I want to hear a lot about is, what are we working on with these new solutions and where are we at with all that?
Well, let me start with the liquidity one, because I think that's probably the farthest along, which we've been working in now, boy, I'm going to say almost a year. Um, I think from a regulatory perspective, our primary recommendations have been that we need to go to a time sequenced liquidity. What we basically told the regulators is we've gone from a cash society to a digital society. Therefore, liquidity needs to change accordingly. We no longer are going to have people lining up outside our doors like Jimmy Stewart, withdrawing cash. Instead, people are going to whip out their phone and they're going to move money instantaneously. So we need liquidity now, not over the course of time. We're still going to have the daily liquidity computations that we have to do, the normal cash flow stuff, but we really need to get day one liquidity. If there's a run, how would we meet that run? And when we started to look at that, we found some very interesting things. First and foremost, the regulators had always looked at on-balance sheet liquidity as kind of a primary source of liquidity. And the problem with that is you can't get at the collateral for a day or two. I mean, you can't
Right.
close the transaction. So that's not going to help us in day one. So we quickly came to the realization, other than what we had in the Fed master account, the only other things that would count for day one would be our ability to borrow quickly. And that really came from two sources predominantly, and that's the Federal Home Loan Bank System and the Federal Reserve. So we've had numerous discussions with the Federal Reserve over the past year about where they're going and what they're doing. I think they're doing what they can right now. I still think they need to enhance their product a little bit. It can't just be the lender of last resort. They've got to have terms, not unlike what they did under the Bank Term Funding Program, which they came out with about a year ago to solve the prolific liquidity problem. So that went up to 1 year, if you'll recall.
Right.
So I think they need to at least add some term, maybe go out to 1 year. And it'd be nice if they put some optionality in there as well. Meanwhile, on the Federal Home Loan Bank side, we've also had conversations with a few of the different regions, and they recognize that they've got to address their cutoff time. They can't have a cutoff for borrowing at 2 p.m. What if the liquidity run starts at 3? So they've got to be open during the hours that a normal community bank are open. And then secondly, they're not going to be able to really take the blanket liens the way they used to. If you pledged 100 million, they would put a blanket lien against that. And then the problem with that is you can't get at it and at all. So what we want to do is we want to change the definition of on balance sheet to be pledged but unencumbered, as opposed to just pledged. And I think the regulators are kind of going along with that. I think they've also bought off on that we need to have time sequenced liquidity. If you follow Michael Sue at the OCC, he's been talking about 1 week liquidity. We think it's more like 1 day, not 1 week, but they're at least all talking about it. They seem to have grasped the concept, and I think are pretty much in uniform approval that we need to go there. What they haven't done yet, which is problematic, is agreed on what is the ratio, what is the definition, how much day one liquidity do we have to hold? There's a big school of thought that says we have to hold enough day one liquidity to cover all of our uninsured deposits. Well, if you think about a bank that has 40 or 50% uninsured deposits, and by the way, that's pretty typical. That's a lot of day one capital. So I think it can't be that. I think it's going to have to be some other metric. Maybe it winds up being, a minimum of 20, but a maximum of 60% of day one liquidity or something like that. But all that
This is such a great conversation. I mean, Don, we've had the same talk a million times that the technology's outran the efficiency process and stability of what we can call banking today, right? So if you get, whether it's a bank run, a digital bank run is what we're talking about here, or whether it be, the ability to KYC somebody and then take that and, port that over through 1033 to somebody else, right?
Yep.
There's a lot of fallout that it's like nobody sees the ripples in the pond that go all the way to the shore. And when you really kind of look at some of the things that we're just talking about implementing or instituting some of these things, it's like, wait a minute, wait. Play it all the way out. Play it all the way out. And back to, how do we stop a digital bank run? Well, hey, let's just call the online banking and call the, the mobile guys and say, can you stop this thing more than 250? Nope, we can't do that. We can turn it on or we can turn it off, but we can't do anything else. And the minute you turn it off, you're liable for, oh my God, right? All right. Now we can't really adjust this from a technology perspective, but yet we created it from a technology perspective. And that's really where we kind of come into this, I call it, conversation, is that the regulatory side of this fence has got to step up on the technology game and understand the things that they're implementing from the technology, perspective, what that plays out to everyday banking, because we will create a more unstable system if we're not careful.
Dave, you are 100% right. I mean, all you got to do is look at what's going on in Washington today, where there's a bias against fintech and there's a bias against banks partnering with fintechs. Banking as a service is literally a four-letter word in Washington right now. So is lending as a service. Now they're going after third-party deposits, which are all fintech generated. I just don't get it. I think that they're way overreacting. And as you suggested, instead of them looking at the end game and saying, look, how do we work with our banks to get them where they need to be at the end game? It just seems to me like they're throwing their arms up and saying, this is too complicated. We don't want to deal with it. And so therefore, we're going to say it's bad and we're not going to deal with it.
And I think there's a misunderstanding too, because especially as you have the regulator conversations, it's the outcomes that they're interested in. Let's say that that's innovation and that's what's best for a consumer, right? The actions that they're taking and where they're most frustrated actually are the worst outcomes to that end, right? If we don't have the sponsor bank and we don't have safety and soundness there, then there is no fintech and there is no competition and technology for the end users. And I think that there's just kind of a fundamental basic misunderstanding of everybody at the moment and a knee-jerk reaction at the same time, right? Which isn't shocking.
Yeah, and I don't know how much of that is just purely political, right? I mean, David, it came out yesterday, with the Republican platform where they basically said, hey, we're going to relook at crypto. It's not necessarily the disaster that everybody's making it out to be. And I think when Yellen and McWilliams was there and we had some of the other Republican heads of agencies, there was a much more willingness to engage with fintech. So I think this election is going to be paramount to determining how banks and fintech interact going forward.
You bet.
Yeah, no doubt. Yeah, there's a fundamental flaw in what we're talking about here. And I'm scared to death that we're going to make this huge mistake. That somebody's going to, let's reintroduce the concept of a fintech charter.
I thought that's where you're going.
Man, I'll tell you what.
I have the same fear.
I literally sat in a meeting and I watched one of the former OCC heads talk about, hey, maybe it's not a bad idea. And I'm like, and every banker in the room is nodding their head. And I'm like, whoa, everybody stop. This is exactly, you want to have credit unions 2.0. This is where we're going here. Somebody that has half the regulations that you have to deal with and can compete with you at a level that you can't compete. Let's not introduce dumbass ideas to solutions. There is a way to do this stuff correctly. And I think when we get to, whether we want to, let's say the the insured deposits over 250. There's a lot of players out there that can do that. We've got R&T, we've got Intrify, other guys that can do these types of things efficiently, and we're able to go at the end of the night and go back and say at any moment in time, even where's the secured ledger, where's everything at, and we can put this money back together in a heartbeat. So being able to say we can't ledger properly is not a true statement. And if you want to get to the regulating a ledger, okay, I can go with that. I mean, Tanner, Don, am I on the wrong? I'm thinking right here.
I think my issue, so there's a lot of focus on the ledger at the moment, which, hey, right, everybody's waking up good. My issue more is around sort of the network effects. And I mean, look, I think, the deposit networks is a good example of that, of, hey, we've created a network of lots of institutions. Where that gets interesting is sort of the middleware connector platforms for me, right? You got, a half a dozen sponsor banks all moving money, and it creates sort of a micro network of those banks. And then some of those banks are also involved with other networks or other middleware platforms. And now you've got cross-pollination. It's just like a poisoning of the well environment that's going on. I think that's probably the next conversation. And to your point, it has to fit in the ledgering conversation because everybody's subledgering everything because of core pricing. And we all know the problems with all that go back a long, long way, right? But I think ultimately the ledger conversation and sort of this network spiraling money movement effect, right? And think about things like sweeps. Who owns the sweep account? Is it the bank or the fintech, right? All of those to me are actually kind of one nasty intertwined bubble to think about.
And that wave is hitting the beach as we speak. The Yala, Synapse, and Evolve situation, the Synapse bankruptcy to be specific, and the missing, call it 80 to 104 million. Nobody seems to know what the number truly is. But that was a direct result of having multiple ledgers. And I can tell you some of the changes I'm hearing are that they're not going to allow fintechs to have ownership in the account. They're not going to allow them to be titled in the account anymore. So, and all that sounds good on the surface, but then they overdo it. So they'd say to us something like this: well, we've got to limit the use of, for a benefit of, FBO accounts, because that's what all the fintechs are using. And you say, okay, well, that's great, but what are we going to do about real trust organizations that really, truly have for benefit of accounts? You can't just say we're going to eliminate them.
Right.
Let's talk about a real solution here. And there's no doubt out of Synapse that we're going to get something. I mean, there's a mild panic going on around that.
You bet.
Oh, absolutely.
Ultimately,
when we get to the whole conversation about, what is FDIC insured and what is an FBO account designed to do and what's it not designed to do. And I think that, I'm going to go out here and just say this, guys. I've been screaming this for 2 or 3 years, man, that this day's coming and it's going to happen probably this way and exactly what we called it. Okay, call it luck or whatever. But bottom line is this: what's at risk now isn't the middleware connector model. What's at risk now is the FBO model. And I think that's the part where everybody needs to whoa, shutter yourself all the way to the ground, because there is not a fintech solution out there for the most part. There aren't any that aren't set up one of those two ways. And when you take the FBO situation completely off the books, right now we're back to Encore. And this is where I want to get back to this conversation of where I started screaming a couple of years ago. Stop using the word legacy core because it makes everybody want to go to a different level of technology. We have a situation that works today.
What I don't understand is why more people aren't going to some of the new online providers and setting up a separate, if you will, core that they're running some of this stuff through. But it's a direct account. That's the way to do it in my mind. I don't know how you guys feel about that.
Yeah, that's exactly what we've talked about.
Hold on, wait. There's a problem. Let me run through this real quick. What happened in the old days is that core pricing, especially per SIF pricing, was too expensive to put kids from a fintech on, right? So we went down the FBO path. The other thing that was a huge mistake of virtually all the digital banking providers, if you really dig into it, they're very good at read-only, but they don't write to core very well. It's why the account opening space has always been a fiasco.
Yes.
Anybody can read just about anything from core, and we go out and have 50 core interfaces with hundreds of calls, right? We can read stuff, but when we start having to write and create records, open new accounts, things like that, it gets difficult. So pretty much systematically across the digital banking environment, and most of which is owned by the cores today, that ability to create is missing. And so if you think about it, I agree with Don completely. I think that this, let's just say middleware or ledgering to core problem should have been solved by the digital banking providers.
Yes.
And if you look at, say, Q2 with Helix, right? I think that's a very good example of they're one that's on the right evolutionary path. The others have struggled, and frankly, many of the others have been acquired by the cores. So it's not shocking of how we arrived here, right? But that's where this conversation should probably live, I think, is with the digital banking providers.
And I almost think it's going to have to, Tanner. I think what's going to come out of Washington as a result of the Synapse bankruptcy, they're going to come out and say, we're not going to allow fintechs to at all be involved in the ownership chain of the transaction. And that means we're going to have a direct account at a bank in one way, shape, or form, not for benefit of. And I'm now going to take away the trust and some of those other things. I think that those will be carved out. And then I think the next thing that they're going to do is they're going to say an ownership of that account has to be with the bank, because we can't have claims of FDIC insurance out there if, in fact, the dollars never made it to the bank to be insured.
Yeah.
Yep. I mean, it makes all the sense in the world.
End up with is this conversation of an on-core solution that is brought to you by the legacy cores as a sidecar. And so whether we want to look at, FinTech for Fiserv, or with a DCI solution or CSI solution, there are solutions in play. Unfortunately, FinTech showed up before those solutions were in play. And so those current solutions that are in play now actually is how we should build things from going forward, because you do end up with a situation that where you do have your core, but you can set up another core separate from it that actually has all the FinTechs attached to it. That one little FBO is simply between two cores that are the same. So it's a core to run your bank's clients in your local community, and another core that's attached to it that is a separate ledger for everything else. A lot like the branch banking system.
Yep.
It's also a lot like the big banks. I mean, I bet you JP Morgan's running like 38 core systems, right? They got like 9 different loan cores. You know what I mean? I mean, it's a disaster. But it's that same dedicated subledgering capability is really what they're after. And clearly the big guys make it work just fine.
Yep. Well, I mean, you can already see this playing out in the regulatory world. The FDIC in April, in their exam guide, exam manual, came out with a new definition for wholesale funding, where they literally have included everything but the kitchen sink into it. It's way too broad. But there's literally, of the 5 or 6 lines in the definition, 3 of them are dedicated to third-party transactions. And in their minds, everything is a third-party transaction. Even IntraFi, even Stonecastle, even RT, all of them. And so we're getting to a stage where, I mean, come on. So I had the fortune of being with the regulators recently, and we were talking about third-party deposits. And the other thing that they said that really troubled me, I said, why didn't you just examine Synapse, not unlike the way you do the cores and all that? And they said, well, there's close to 500 individual fintechs that we would have to examine, and we don't have the resources to do that. So we're doing a risk-based examination process right now, i.e. they got to get to a certain size and mass, and Synapse hadn't quite hit that yet. And so it's like, I wonder when that's going to see the light of day. And you have to believe that all these fintechs are going to have to go through being SOX compliant. They're going to have to go through third-party reviews, model validation, all of that. So, I mean, I think that what we're going to see in the next 6 months is just going to be wholesale change in the fintech space.
It smells that
way. Good.
I think my first question to them would be, how the hell do you know?
Yeah.
How do you know if they've hit that size or not if you're not looking at it?
Yeah.
And I'd say that from this perspective of, they get data from us. We talk with them regularly as well. And the questions that I get are stunning as far as like, you didn't know this, you didn't know that. They're not on top of this game. They're playing from behind.
Which is an important note, right? I mean, a lot of bankers that I've talked to, especially the more innovative, the bankers that are sharp, up to speed on these topics, are participating or farther ahead. Everybody's head just has the question mark above it, right? Like, what in the world? And that's really, if you boil it down, the answer is really simple. The regulators for a long time, like a number of years, said, we got it. Right? We know what's going on. We've looked at it. It's all cool. And then when they got it and the light bulb came on, they went, oh shit, we don't got it. Oh my God. Right.
That's it.
And that's all that's happened at the end of the day. And so you had this knee jerk that was really going backwards. And you got a lot of bankers. Frankly, I mean, there's some consent orders out there that are necessary, and there's some that are like, what a joke, right? And I
Pretty
mean,
light.
this is pretty light, but you can see that knee jerk of they started to see the scope and how systemic things were. And they also saw that they had pretty much said okay to things and reviews of things and audits that they're like, ooh, actually, right? I'm less comfortable once they began to understand. And so you kind of got this knowledge coming of age thing going on that's interesting.
But
But
them
what you're
taking
going to
the
find,
approach to just say we're going to outlaw it and we're going to give everybody a 4 rating and everybody's going to be a troubled institution if they're in any of these things, that's not the answer.
No, I mean back to the
Let's
point of
actually address the problem.
right. Yeah, back to the point of they don't want to stop fintech and access and competition and what's best for the end consumer. So it's kind of talking out of both sides of your mouth, right? It's the
Sure
chicken and
is.
the egg a little bit.
well, I'm going to go on a limb here. I bet you Don will agree with me on this one. We can have multi-bank holding companies from national organizations that have banks in damn near every state and thousands of branches underneath those. I'll bet we can figure this out. This isn't that tough. It's that we're ignoring a lot of the current systems in place and requiring people to use those systems that are in place. That's why I keep going back all the time to the legacy core, the legacy course. This is not something we can't do. It's just more expensive. And the idea that we have to put every, 100 million accounts onto this bank. Well, you don't have to do it that way, but there is another way. Now, is it as cheap as going through some middleware or do some backdoor bullshit that we've been doing up to now? No, it's probably not going to be that cheap. Well, that's a Silicon Valley problem, not my problem. But safety for the consumer, visibility for a regulator, and having clear ledger and ownership of those accounts at the bank level. This is the problem with it, guys. It's not does it work or doesn't it work. It's that when it doesn't work, people are sitting here, they can't get around their arms around the idea that Monday morning I can't go get my money. No, you are now a creditor in a bankruptcy operation. That's all that's going on here.
Yep.
Welcome to the world. It's going to be just like any other, you had somebody else go bankrupt and you're sitting here and it's going to take 50, 60 days to get your money back. That's not banking, and that's not what we should ever have allowed to have happen in banking. Shame on you for allowing it to happen. Those that did it, knowing this was an opportunity that and a possibility that this could happen, shame on you too. But at the same time, what was the answer? The answer was just more expensive than people were wanting to do.
Mm-hmm.
So, Dave, were you as stunned by I was at the letter from a bunch of senators over to the regulatory agencies, basically telling them we want you to have Evolve open its doors and give everybody their money and all that? I mean, the Senate doesn't understand it.
Exactly.
I read that letter and I couldn't believe that they actually wrote that letter.
Well, and I saw on TV.
I hope to God that was politics.
Jerome Powell named Evolve by name and essentially saying, do whatever it takes to get the people their money back. You can just see it's a breakdown of understanding, but everybody's up in arms and nobody really knows who to point the finger at.
Yeah.
We get to the politics versus the reality. Okay, so us being banking people, we see the reality a lot faster. The politics is pretty simple. You bailed out SVB, and everybody got their money, but you can't take care of little guys over here that got their money in Yoda or whoever, right, or Mercury or whatever. Okay, it doesn't seem fair, but it isn't the same thing. And
No,
we need to
right.
move the politics to the politics table, and we can all make up bullshit and say anything you want to say over there. That's always been the case. You can lie your ass off. You can do anything you want at the politics table. When you get to the balancing the books part at the banking level, there is a way to do this, and it doesn't have to be done this way. Now, what we need to do is stop that process as fast as possible, clean up on aisle 3. What's happened has happened. The issue is not how fast you get these people their money. The issue is how fast you stop leaving this exposure on the table.
100% agree. Very well said. So, and hopefully the agencies in Washington pick up on that. If I'm a betting man, though, I would tell you, I don't think that they're gonna do the right thing here. I think that what's going to happen is they're going to use the Synapse bankruptcy as a way to go to every single bank that is involved with the fintech and say, have you modeled what happens if either the fintech or the IT middleman, whatever that might be, goes bankrupt? What does that look like? And is there
That's
any
right.
exposure in that chain whatsoever? That's what's going to happen.
Exactly.
Which is going to
Exactly.
take us, look, I say this all the time. If you look at how this technology environment operated when it was at its most healthy, it was maybe big cores is too big of a word, but it was lots of cores of size and stature. And then you had startups that get off the ground, have a new environment and a new part of the industry until they get successful enough and they get bought up. And you had a really nice ecosystem and life cycle there that went on for a long time. Maybe we could argue some of the big cores got too big, or we didn't have enough funding to the bank technology folks. And maybe too much of that funding went to the direct to consumer challenger folks, right? But that life cycle is a little bit broken, right? And if it wasn't, then we would have the cores adopting the technology. But ultimately, I always make this point, it always ends up with the core, right? The answer to whatever new interesting problem, because of the way that our ecosystem is structured and built, the answer has to be at the legacy core, right? And I think it's the end of the day, anybody who thinks otherwise just doesn't have enough experience. I think everybody wishes it could be different. We all do sometimes, but ultimately it has to end up with the core.
So step back here real quick and everybody just kind of pause. What we've talked about so far are two major issues. One is the liquidity issue that caused the bank run at SVB, right? The digital bank run that's still out there today. It could happen to Chase. It could happen to anybody. Okay. That's what Don's talking about, is we've got to solve that problem. Now, you can either go from the technology side or you can go this thing from a regulatory with a new method of liquidity funding that's a daily method of doing this. Okay. That's one huge problem that we've experienced this in the last 12 months, right? And then here we are, say a year and a half, whatever. We've experienced the other piece too, which is the fact of not being able to ledger money correctly in fintech so that we can put this into the bank account and have the ownership at the bank and have FDIC actually step in and regulate this process the way it should be. Both of these examples that we're talking about have happened to us in the last year and a half. And both of these examples have come through the use of technology. And they're solvable problems, and we already have the solutions to solve these things. We're just not having the willingness from the regulatory front. And you're going to find the other half of the people in this entire conversation that disagree with everything that we say. What they're going to turn around and say is, well, we need the regulators to give clear guidance. Understand, the regulators cannot give clear guidance to a problem they don't know the solution to. That's not reality. And when I come back to people and say, we have the solutions in place, and watch what we do here. This is what we do. We clean up these things. We haven't lost a bank yet. We haven't had anybody go have a problem even, because we show bankers how to do this stuff the right way. The right way is out there. It's a matter of the willingness to do it and pick up the cost that it takes.
Good call. I agree with that. And don't you think that there are going to be those, I'm going to use the word fintechs, that might be too broad of a term, but don't you think there's going to be those organizations that are going to get this pretty quickly, and they're going to change their operations, and they're going to change their contracts, and they're going to do really well now for the next 3 or 4 years. And then you're going to have those that are ostriches, and they're going to put their head in the sand, and they're going to hope this thing blows over, and they're just going to get crucified, because what's going to happen is the regulators are going to come in and tell banks, you can't work with X anymore. And the minute somebody gets that kind of black mark on them, they're done. It's over.
You got it. Yep. Don, you nailed it so good here, because I completely agree. You're going to have, so let's start with what you just said. FinTech's not going to go away.
Right.
Those that are doing it are going to do it a different way. Let's say do it correctly. Okay. They're still going to win and make a hell of a lot of money doing it. All right. And then you're going to have the guys that are going to continue to do it wrong until they get busted. They're going to die. They're going to get hurt severely, much more than what they think they're going to get hurt going forward. And then you're going to have the new guy that is scared to death to do anything. He is maybe afraid to walk into this. And I'll tell you, even today, there's still a ton of bankers that are like, show me the right way, show me the right way. Once we show them what the right way is, and they're like, that works. It's like, it's not that hard. But if you're willing to take on the steps and the things that it takes to do this the right way, there is a huge opportunity. And I want to say this once and for all, loud and clear to everybody. FinTech is going to get much bigger from here.
They're not going to turn off FinTech. And even if we talk about it in terms of embedded finance at brands and retailers, et cetera, this ultimately must be, if it's not your dedicated strategy, it's got to be a supplemental strategy. I don't think, and however distant of a future, the traditional model alone competes very well, right? And I mean, we're damn sure, I mean, look at the math everywhere. Unless you're in some little microclimate, right, very rural, you're already getting your butt kicked, right? If there's any major retailers, like I talk about HEB, right, the grocery store with a debit card, is that my customer or is it my competitor? And it's like, you want to make them your freaking partner, I promise, right? And so I think this is an interesting case because we can all be clear of the fact that the regulators are not going to turn off FinTech, right?
Let me go. I'm sorry, go ahead.
No, that was it.
Let me expound on what you just said and run this one by it, which is maybe it's even more troubling. Not only are they talking about third-party deposits, but they've included in the wholesale funding definition all internet deposits. So that means if I walked into the bank branch today and opened up a $10,000 account, okay, that's treated as a retail account. But that night, if I went in and opened the exact same account at the exact same bank, but I do it digitally, somehow that's an internet, somehow that's wholesale funding, somehow that has a different risk parameter than the one I opened at the branch in the morning. I don't know how that can be. I mean, to me, the delivery channel is that ship has sailed. It's gonna be digital. Guys, get on with it, right?
Well, that's it. And whether this is now we've crossed over into a conversation of AML and things like that, right? And so you move into this new level of we've got to be able to tell a ghost from a real person, and we can't do that effectively. Again, we've let the technology outrun the race. Either make people come into the damn bank and open the thing, or figure out the AML side of this thing and start regulating the shit out of FinTech on the AML side of the equation. Sarah Felix and people like that have just pounded the table on these issues. That these are not overwhelmingly difficult to understand. It's a lack of willingness to do it. But yet we'll see senators write letters. Why don't you get off your ass and think this thing through and get with the program of where we can actually solve some real problems here? There's a lot of this stuff that needs to be regulated that's not. And there's a lot of this stuff that's over regulated to the point that it needs to be done just little tweak is all we need to do. Make sure that the core is where the account resides and the bank actually has ownership of the account. Problem solved, and 50% of the problem's there. Yep. But on the liquidity side and the bank run issue that you brought up, Don, that is the monster. I still think that's the elephant in the room that needs to be solved because it will happen again.
Hey, Don, I want to give you a couple minutes, man. Final thoughts and keep rolling on whatever you want. But anything else, man? Anything we haven't talked about, dive in.
Yeah, I just want to throw out there one other thing that we're working on here, which is called the Community Bank Uninsured Deposit Program. And what basically we looked at is as a result of Silicon Valley, and they wound up calling it systemically important. Therefore, they made sure that the uninsured deposits were covered. I did some homework. I went back and looked. Since 2013, not one uninsured depositor has taken a hit because the FDIC resolution group in Texas has done that good of a job of matching up buyers with a failed bank, right? So I looked at that and I said, okay, why don't we just do that on a grander scale? And so what we're proposing is we put a consortium of banks together, and maybe work with you guys to do this. And we go out, we get this consortium together, and we say, if there's a failed bank and it's a member of the consortium through a lead bank will go and we'll do an all bank, all deposit purchase, which protects all the uninsured deposits, which then no longer gives the big banks this competitive advantage. I think that's the next thing. And if we do that, by the way, then I think some of that day one liquidity need diminishes greatly because nobody's going to have the need to run anywhere because they're going to know that they're protected, right? So
we had the same idea.
Let's fix the problem.
We had the same idea, and it was just a case of get a a third party insurance, another insurance to cover that, and then pay that premium with that. Now, does the safety and soundness that surrounds that outweigh the cost? If it doesn't, let's figure it. Let's at least start with what is the cost and quantify that.
Yeah. So we're doing it a little bit differently. We're not actually going to have insurance. What we're actually going to do is if we were three banks, we're each going to agree that we're going to be a consortium, and if any of the three of us fail, the other two will step in and acquire all the assets and deposits. Okay, so there is no insurance. It'll cost 2 to 3 points only, half of what FDIC insurance costs, and 1/4 what IntraFi and some of those other things cost. And all that would happen is when a bank failed, a member bank fails, the consortium, which we think has to be at least 200 banks to have critical mass, will step in and it will absorb, all of the assets. Remember, it still will get the asset guarantees from the FDIC, just like any other all bank acquisition would. So,
Right.
It was a different way of looking at it. Now, again, the FDIC could solve this problem by simply saying, we're going to protect all uninsured deposits by making sure that any failed bank always has a bid.
Yep.
Same
Right.
thing. Then they wouldn't need us to step in and do it for them.
There you go.
I agree completely.
Love it, man.
Yeah.
Look, this is so fun. I had a ball with you guys. We got to talk. I could talk to you all day about these things, but this was awesome. Really, really cool. And Don, super appreciate not only all the stuff and years and the effort and everything you're working on, but all the forward-looking things and all the parts and pieces we talked about today. I mean, you're on the bleeding edge of these things, and we need guys like both of you guys. So appreciate you guys. Thanks for joining us. And
thank you for having me. I appreciate it. It's always great to talk with both of you.
You bet, man. We'll catch you guys next time.
All right. Have a great one.
Okay.
All right.
We'll
See
see
ya.
ya.
Bye-bye.